Sure, you've probably heard people throw out terms like mutual funds and index funds, but what are the differences and which one would be better for your portfolio? You might think that the difference is minimal, and while it may seem that way, the difference between these two investments could be hundreds of thousands of dollars over the course of your investing career. Learn the differences between these two common investment vehicles to ensure your hard-earned money is providing you with the largest return for your retirement years. Mutual funds. A mutual fund is at its core a managed portfolio of stocks and/or bonds. You can think of a mutual fund as a company like Fidelity or Morgan Stanley that brings together a large group of people and invests their money on their behalf in this portfolio. Each investor owns shares of the mutual fund, which represent a portion of its holdings. Mutual funds are operated by money managers who create portfolios for investment with the pool of money. Some managers, like fixed income managers, focus on generating low-risk, high-payoff investments for their funds, while long-term growth managers try to beat the Nasdaq or S&P 500 during the fiscal year. The objective of a mutual fund is to beat the investment returns of a related benchmark index. The benchmark index, or market, is simply a measurement of a relevant section of the stock market. These funds are actively managed by mutual fund managers, stock pickers, and analysts that are constantly working to ensure the holdings of the fund will be the most beneficial for the investors. The funds are usually invested in a mixture of stocks, bonds, and similar securities. While it may sound great to have your own team of fund managers looking out for your portfolio, working full-time to ensure you're receiving the best returns possible, there is one major difference between mutual funds and index funds. Managing a mutual fund with daily or hourly investment decisions is very expensive, resulting in extremely high fees. Actively managed mutual funds are more costly and annual fees of 3% or more aren't uncommon. This means with a nest egg of $1 million, you could be paying $30,000 in fees annually. Index funds. An index fund is a type of fund with a portfolio constructed to match or track the components of a financial market index, such as the S&P 500. As with mutual funds, there are many index funds available. For example, you could purchase a fund that is solely invested in growth stocks, you could purchase a fund that invests in dividend-paying stocks, or you could invest in a fund that owns only international stocks, or a fund that is invested in small-cap companies. Most common are index funds that track the S&P 500 or the Dow Jones Industrial Average. An index fund is said to provide broad market exposure, low operating expenses, and low portfolio turnover. Index funds can be a selection of stocks, bonds, and similar securities that are designed to mirror the market index as opposed to outperforming. An index fund that tracks the S&P 500 will provide a return equal to that of the S&P 500, less any expenses that the fund incurs. Index funds typically have low costs, with the cheapest choices charging less than 0.2% per year in expenses. The funds aren't actively managed. Instead, the investment mix is automatically managed to match the market trends. Performance is solely a result of market changes within a certain selection of stocks, not someone trading in and out of stocks. As a result, there is a dramatic difference in management cost, or what's called the expense ratio. The index fund fees or expense ratio will be close to $2,000 annually on $1 million account. Tony Robbins says that if you have two people, each with $100,000, and one person pays 1% fee on their investment fund, and the second person pays 3%, the person paying 1% will have about double the money in their account over time. The average mutual fund charges 3.1% per year according to Forbes, which is a substantial amount in comparison to the average index fund, which charges just 0.2% annually. Consider purchasing index funds with tax-advantageous accounts or with commission-free brokerages like Robinhood to save even more. Paying attention to the fees you're paying is critical because it could cost you hundreds of thousands of dollars over time. In any event, an index fund is simply a fund that, instead of having a portfolio manager making selections, the investment selection is automatically tracking the market segment. History has shown that it's extremely difficult to beat the market over time. Index funds allow you to invest in the market at very low cost instead of paying a higher fee, so experts can attempt to outperform typical investment returns. Time after time, we've seen that the low cost of an automatically managed fund far outweighs the benefits of an expensive, actively managed fund, which incur a percentage of your portfolio year after year, whether or not the investments lose or gain value. Overall, index funds that let you invest cheaply in a representative sample of stocks can be a very efficient way to invest with very little thought or oversight. However, if you can stomach expense and feel confident that you can find the rare, actively managed fund that will outperform the benchmarks, then you're free to try to beat the odds and go the active route.